Today we're going to talk a little bit more about risk management. Risk management is really the business that we're in. When you think about it, we're in the insurance business because what we're doing is we're collecting premium, we're collecting theta from other traders who are taking directional bets. So our business is really just the guy who manages the risks, and we have actually a lot more freedom than market makers or specialists on the floors do because we get to take the trades that we want and at the price we want. So in today's video, what I'd like to talk about is risk management, specifically risk management as it applies to our business. Any business is going to have risk. And I mentioned in the previous videos the four main risks that you have, plus price. Price obviously is a risk because that's what makes the markets go up and down. People have different opinions of price. They trade accordingly, and whether they win or lose, that's what makes a market. So what I like to do today is talk about risk management. And that means that you have to think about your portfolio. I'd rather have you in the mindset of being a manager of your business, your trading business, and the thing that you're managing is the risk. Really, any business is going to manage risk because if you go to a bakery or if you go to a gift shop or you go to any kind of business is going to have risk. So, for example, a bakery. Let's take that just for an example. You go to a bakery, they have cakes, they have cookies, they have all kinds of baked goods, right? Muffins and cinnamon donuts or cinnamon rolls. What is probably, if it's a big bakery, okay, even if it's a small bakery, but if it's a bakery, what do you think their primary risk is? Their primary risk, and I don't know anything about bakeries, but I'm just guessing here. So if you have a bakery and you know what the exact risks are, email me, let me know. But what I'm just saying is, because I don't know anything about it, but to me, just looking at a bakery, I would say the risk is the purchase of wheat or flour. See, I don't know anything about bakeries. Flour, butter, eggs, those commodities that they need in order to make their product. That's the big risk to them. The bigger the bakery, the more flour they're going to need, the more eggs they're going to need, the more butter or margarine or whatever they use. Those are risks that they need to manage. Now, a lot of times they can pass on those costs, but what happens if, for example, flour prices and wheat prices have really skyrocketed, in the last few months? Now their costs are so much higher. But there's only a little bit of price movement maybe that they have in their product themselves when they sell it to the consumer after their labor costs, after electric, utility costs, and their raw materials, which is the flour, eggs, and butter. They don't have a lot of control over a lot of their business. And also they don't have they can fluctuate their prices. Yeah, when their costs go up, yeah, maybe they can raise the price of some of their products, a little bit. And I think the consumer would probably still, purchase in a certain range. But once the prices got above that range, they're going to see a dramatic cut in their sales, because if prices go a little bit high, people are going to start looking around for alternatives, and they may end up going someplace else. So, their risk is the raw material costs. Now, they also have labor costs. I mean, labor costs are also a risk, and those are even harder to manage. I mean, flour, eggs, and butter is probably one of their main costs and one of the risks of their business, because if those basic commodities rise in price dramatically, then they're going to be in a position where it's really going to cut down on their profit margin. Then, in fact, they may even lose money. So how do they manage those risks? Well, a lot of times what they can do is they can purchase ahead of time. They can place their orders now for a certain price to be delivered at a future date at the price today. So if they think flour or eggs or butter is going up in the next 90 days, they might place a large order today at a fixed price so that they don't have to pay the prices 90 days from now, which may be a lot higher. But it also ties up more of their capital. And they also have storage costs. They got to keep this stuff someplace, right? So they're buying a large order now that would last them for several months. They have storage costs, they have additional costs, even though they think that they're buying it at a lower cost, but they have other costs associated with holding that commodity for a long period of time. So those are the kind of risks that a bakery would have. Every business has. My point is that every business has risk. It doesn't matter what kind of business it is. So the primary risk of our business, as I mentioned, there were 4 of those. And one of those really has to do with the allocation of capital. So in this particular trade, now we're getting down towards crunch time in our positions. We are actually less than 5 days away from expiration. Let's just take any symbol here, and you can see here that we've got, counting today, they have 6 days to the last trading day. When we get to Monday, we will have 4 days before the last trading day. Today is a Saturday, so we're doing this over the weekend. And our primary risk going into expiration is the fact that the price can move dramatically against us, right? And then wipe out our potential profits that we've accumulated. Let's take a look at a second. I want you to block out these QQQs just for a second. Because our primary position was the diamonds, the EEM, the IWM, and the SPY. Okay, those were our 4 main positions. I added this QQQs, and I'll tell you exactly. The whole point of this video is those QQQs. So I will talk about those. But our primary position was the diamond, EEM, IWM, and the SPY. Now the diamonds, we've got an open profit of $177. Our EEM isn't quite doing as well. However, the theta has increased dramatically, and that was a little bit of a difficult position to manage. We're only up $13 on that, but we do have a small profit. Our IWM position is up $228, and our SPY position is profitable at $370. So our total open profit here, if we take a look at this column, our total open profit on our portfolio for this month is $783.50. Now remember, we're only doing like 1 or 2 contracts on these, so there's very, very small positions. And I will tell you again, you want to do very small positions or you want to paper trade. Now paper trading has its place. I would do paper trading for several months if I were you, doing 1 or 2 contracts. I know it's really boring. It's not exciting at all, but good. That's good. Boring is good. Because you want to develop the skill set that you need in order to manage your business. So if you manage your business in paper first, doing 1 or 2 contracts, paper trading, and then going to live trading with only 1 or 2 contracts on each of these types of positions, you're going to be in a better place because you have the skills. And what we're trying to do is develop the skills in you to manage larger positions. Eventually, you will be able to get on to larger positions. Now, if you start live trading and you're doing 1 or 2 contracts and you're getting nervous about your positions, maybe this isn't the business for you. Okay, I'll be brutally honest with you. If you're worried about losing a couple bucks, $100, $200, $300, $400, even $500, even $1,000. And that can happen in this kind of business. I'm not telling you that you're going to make money every single month, okay? But what we try to do is manage the risk as the best we possibly can. You have to develop the skill set to make the profits, though. In order to make the profits that you want, you got to have these skill sets. So anyway, I went off on a tangent here. So we've got open profits now. And I told you we have like, when Monday comes, we're going to have like 4 or 5 days before these positions, our May positions, expire. Common wisdom would tell you that you don't want to hold these positions into expiration. Let's just take a look at our analysis tab for a second. Without the Qs, I took the Qs out. You can see down here. Here we are on our overall position. Now, if we were right in the center, we'd have a profit of $837 on our portfolio. This is our entire portfolio. However, we're down about here, which is not a bad position to be in. It's not really too bad at all. We have an open profit of, let's see here, $600. Actually, it's closer to $783. I can never figure out why that's a little bit different. But anyway, it is different. I got to check our dates here. Let's see what day they've got. And they got us on the 10th. Okay. Well, anyway. There we are. Oh, all I had to do was say go to today. All right, here's a little calendar. Just say go to today. Click on go to today, and there we are. Now you can see we're up $788 on our position. So, what risk do we have going into expiration week? Well, we'd like to capture as much profit as possible, right? We currently have an open profit of $788 for the month in this demo account. We'd like to keep that profit. Not only would we like to keep that profit, but we'd also like to make the maximum profit if possible. As you can see, when I hover my mouse over our current price on the IWMs, now this is portfolio beta weighted, okay, against IWM, which is just one of the positions that we have. It shows that we have on, if you look down here in the left-hand corner, on May 10th and May 17th. May 10th is today. We have $789 of profit. May 17th, we have the potential of having $1,646 of profit. Now, when you have 50%, okay, 50% of your potential profit, maybe a good idea to take that, right? I'm not saying don't take it. That's good profit. Now we're only doing 1 or 2 contracts. If you had 10 contracts or more, you're talking about $7,000, $8,000 in profit. However, there's a difference between $789 and $1,646. It's close to $900. What if you now this is a bit of an advanced technique. Okay, and I don't expect everyone to do this. In fact, for a lot of you guys and girls, forget it. Don't even think about it. It's kind of an advanced technique. There's a possibility that it could go in a completely different way than you expected. However, think of it this way. If you are, in fact, a manager of risk, you're a risk management company. Your business is risk management. We are not in the center. We are not way over, but we are considerably over to the left of this position. We're not way down here, so we're not really in bad shape. However, let's take a look at the Dow Jones. On Friday, the Dow Jones Industrial Average dropped 120 points. It broke through the support that was kind of set up over the last 5-6 trading days. Let's just move this up a little bit. Right about there. That was kind of a key little support level there. Now remember, I'm not particularly a guy who likes to, look at technical analysis. The only thing I'm really looking at is support and resistance points. It was support here, it was a support here, it was a support here, rallied up, came down, it was support here, it was support here again. So how many times is that? 1, 2, 3, 4, 5 times it hit this line right here, right around the 12,794 level, and it bounced off of it. That shows that at that time the market was being supported at that level, and all things being equal, it would have held again. The fact that it hit that line 5 times and then broke through it here on Friday indicated that perhaps there was enough selling pressure in the market, enough urgent selling pressure in the market, that brought it below this line of support. And it broke through it, and it traded down 120 points. The big picture here is that you are, in fact, trying to manage your risk. Now, because the IWM, it didn't go down that much. It only went down about 21 cents. But what happens if we get a sell-off? Now, we're holding this over the weekend, and we're going into expiration week. What happens if we get a sell-off of $500, $600, 600 points on the Dow? Where is that going to bring us? It'll probably bring us down into this level here. And that also potentially limits our potential profit. Now, right now, remember, we have a profit of $789. If prices move down into here the week before expiration, our maximum profit now, if you can see down here in the left-hand corner, just follow my mouse down and follow those numbers, is only $1,000. And our actual profit, we would have, for the day, we'd only have $300 profit. So we would have lost close to a $500 profit. Now, what's the number after fluctuation? There's only a couple rules in the market. One is prices will fluctuate. The second one, as far as options go, they will expire. And what's the third one that I mentioned before? Don't lose money. And that seems obvious because we don't want to lose money. In order for us not to lose money, we need to manage the position that we're in. How do we do that? Very simple. This almost looks like, let's say you were watching the weather station and you lived in the Florida Keys and you saw this hurricane coming. I mean, it's the weatherman is telling you well in advance where the hurricane is going to hit and when it's going to hit. What would you do? Would you just say that, just stay there in your house and just kind of keep all the windows open and just kind of sit back and relax, enjoy your favorite beverage in front of a ball game? Or would you prepare? Sit back and relax or prepare. You knew it was coming. So, if we saw this and we knew that the prices had broken a key support level here going back for a week and a half, even farther here, and we saw it break that support level with the potential for the market to be trading down 300-400 points, what would we do? Now, we don't know, right? We don't know what the price is going to do. We can't predict price ahead of time. Okay? The only thing we can do is manage our risk. Our risk at this point, if we have a hurricane coming towards us, is to prepare for that hurricane. And then wait and see what happens. Maybe it'll veer off course and it will completely miss us. We hope it does. However, we need to prepare ahead of time for that. So, if we take a look at our Analyze tab again here, if we do get hit by a hurricane in our trading position, and we don't prepare for it, especially, now this is not necessarily the case early in the position. I'm only talking about this type of risk management going into expiration week, in which you're trying to extract every potential piece of profit out of this position. So what we want to do is we want to take a look at ways in which we can manage our risk, in this case to the downside, because what's going to we also have risk to the upside, but we got plenty of room. I mean, actually, if we moved up 50 cents, a dollar on the IWM, let's take a look and see where if it compares to the diamonds here. Yeah, let's use the Dow, because we've got our Dow up here. Let's use in our Analyze tab. Let's take a look at the exact levels that we're at. If we're at 127.50, what is that on the Dow? That's 12,750, which is just about where we are, give or take 5 points. Now, what happens if we move up to 128.50? Which is 12,850 on the Dow. 12,850 is right at the top of this red bar, just about. So we would have to do, in order for us to be back in the middle of our position, we'd have to have a complete reversal, and the market would have to go up 150 points. Or at least 105 points to get back to the top of this. And even if it went up to 12,900, what does that do to our position? We are looking very good, because now we're almost at our maximum profit potential here. So we have risk to the upside, but it's good risk. I mean, it's the kind of risk we want. We want it to go up. Okay. What if it goes down? Let's say it goes down to 12,600, which is 126 on the diamonds. Now we're not doing so well. Let's see where that is. 12,600. Do you think it's possible that the market could trade down to that level? That's 12,650 right there. Let's bring it down even more. Let's bring it down to 12,600. Do you think it's possible that Monday morning we could hit that 12,600 level? It's very possible. It's very possible. In fact, we could even move it down further. Say, well, let's see. Do you think it would hit 12,500? Yeah, it is possible, right? That's only 245 points from where we are. What happens under this scenario if we go back to the major support level of 12,300? Do you think that's possible? Yes, it's very possible. Look at the move on some of these bars here. This up day, we had a couple up days here that were 500 points. Here's one that was 400. Here's another one that was 300. If we go back even further, we'll see some down days. You know, this one went from about, let's see what the low was. The high was 12,580. The low was 1223. That's a 240 point move. But we don't know what's going to happen, do we? We have no clue. The only thing that we can do is manage our risk. Now, if we're managing our risk, we're going to manage it to the upside by keeping our position stable, because we have quite a bit of room to move, and we would still make money. On the downside, we don't have as much room, do we? Because we're already, below center. Now, you might be thinking, well, why didn't I adjust the position here by putting on more contracts? Because we're already so close to expiration. There's no more premium. Nobody wants to be buying those options in the front month anymore. They'd be because we're selling the premium in the Mays. Everybody wants June now. There's not enough time before expiration. So how do we manage this then? How do we manage our downside? Our upside is managed by the current position we have. We don't have to worry about that too much unless we go even 350 or 400 points. Then we're in a different situation. Then we manage it again. However, what we're trying to do is extract as much potential profit out of this position as possible. So that's all we're doing. In order to do that, what I've done is I've taken a position in the Qs. I mean, you're talking now. This is closed over the weekend, but you can take a look at this. This is a $1.10 bid, $1.11 ask. That's a penny spread for the at the money option. Those are cheap. That's a very, very inexpensive spread there. I mean, I'm not saying the option is cheap, but I'm saying that the spread is cheap. The difference between the bid and ask is very inexpensive. It's only a penny. Not only that, they're incredibly liquid. Let's take a look at the open interest for a second. You know, 60,000, 45,000, 84,000, 60,000 contracts over here. You know, that's incredible. It's incredibly liquid. In other words, we can buy and sell these anytime we want as long as the market's open. So what I did was, now I want you to take a look at this picture. Now I'm going to add the position I had on the Qs. What does that do? Well, not only does it bring our position right back into the center, we've got a huge amount that we can go down and still be profitable, can't we? So what did it do for us? Well, let's take a look at it without it. That's what we look like. We still got a nice profit. You know, the picture is not really too bad. However, like I said, taking a look at the price action here, we have more price risk just prior to expiration than we have other risks. And we manage that risk by adding a position that gives us an outstanding downside risk profile. Now we can also go up. I mean, actually we can go up a few hundred, 300 points, and we're still in very, very good shape here. So there are things that you can do. You have to really think about yourself as a manager of risk. Now, I don't know how this is going to open on Monday because this is Saturday. I'll do a video as a follow-up, part 2 to this, that will show you exactly what happens on Monday, okay, when we open. Now, is this going to be a long-term trade? No. No. Because what we want to happen, see, the only reason that we took this additional position, let me take these off for a second here, and you can see where we are. We're down here. We want to go back up here. Now, if the market goes up on Monday, guess what? We're gonna sell our little insurance policy. Basically, all we're doing with these QQQs is managing the risk we have over the weekend. Because Friday we dropped dramatically here through a key support level, and if it continues to drop, well, we will make an additional profit here. Actually, this graph does not actually tell you, but the profits could be significant just on the Q position. So, and this is only really current date and expiration, but it actually could go up much higher than this. So what we've done is because we're very close to expiration, and because we have weekend risk, we don't know what's going to happen on Monday morning. We put these Qs on in order to manage our downside risk here. Now we've got quite a bit of room to run, and actually this is not an accurate picture because if those Qs start to, if we do go down, those Qs are going to increase dramatically in price and give us a fairly substantial profit. If we go back up, and we go up 100 points, boy, we're still looking very, very good here. And what we'll do is maybe that insurance policy, this entire insurance policy on the Qs, I call it an insurance policy. I mean, even insurance companies have what they call reinsurance companies, where they go out and they take on insurance policies to manage their risks, and they go to a reinsurance company. So that's what we're doing. We're taking on insurance for the weekend. If we don't need it, guess what? We're only holding it 2 days. We're going to sell it out on Monday morning if everything looks good and prices are stable. Then we're just going to take that insurance off. We'll say thank you very much. How much did it cost us for the 2 days of insurance? Cost us $100. Oh, okay, no problem. We can give up $100 of profit if we go up, right? Because if we go up, and the longer we can hold this position, we're going to accumulate another $1,000. Let's say we ended up right here. We're going to accumulate another $1,000 in profit. So we can afford to spend $100 for that insurance over the weekend. Believe me, it's worth it. Okay, this is a bit of an advanced technique, especially going into option expiration week. But especially during option expiration week, if you haven't closed out your positions and you've got positions going into expiration, now you've got price risk more than any of the other risks I was talking about. At this time, this is the point where you do not want to allocate any new capital. It's too late for that. Now the thing that you need to do is manage your price risk. And if you have to give up some of your profits in order to have that safe, that security of mind that your position is not going to get killed if you have price risk, well, then that's what you do. And that's basically what we're doing. We're going to give up a little bit of our profits to buy ourselves some insurance, and when we don't need the insurance anymore and things look like they've stabilized, well, then we're just going to sell out our insurance policy, say thank you very much. It's worth the $100 that we paid over the weekend to have that insurance policy, but we don't need you anymore. We're back, up. If we go up, we're back up towards the center. If we go down, we cash in our insurance policy, collect a nice profit, and close out our positions for the month, and we go on to our next month's position. Now, how much money can we make? Depends on how much the market falls. If the market falls dramatically, this is not an accurate picture because it doesn't take into consideration the volatility that the short-term options are going to face and experience, and also the delta change. So remember that this is actually probably, if we fall a couple 250 points, we're probably going to be closer to a $1,200 or $1,300 profit here, and then we'll just close all of the positions out. That's one thing that this will not analyze. So not only, if we did not put these on, what would happen? Well, if we get down far enough, we could be in a position where not only we're losing money on the current position, but even at expiration, we could get to the point where we're losing money. And what do we want to do? Well, we don't want to lose money. So, in order not to lose money, we manage our risks, and that's how we manage it. So that's it for today. Hey, this is how professional traders will look at their positions. They will manage the risk based on the type of risk they perceive in the market. The great thing about the market is that, and especially options, is they're highly flexible. There are all kinds of things that you can do to manage your risk, but it is a business, remember. Every business is going to manage their risk, whether it's the bakery who has to buy enough flour now to last them for the next 3 months so that they don't get hit with a huge price increase in 3 months, or it's your business, your trading business, that has to manage their risk so they don't get hit with a huge downdraft in the market on a Monday morning while you're holding your positions over the weekend. So that's it for today, guys. I wish you all the best, and I will follow up this with a second video on Monday morning after we take a look at how price action is opening on Monday morning. All right, trade with confidence, guys. Morning, tradeologists. Okay, today is Monday, May 12th. And what we're going to do is we're going to take a quick look at our trades for today. Now we're going into expiration week, and as I mentioned, we had a little insurance policy on the QQQs just in case we get a big drop in the markets over the weekend. It cost us $65, but that's cheap insurance because we're already up over $140 for today. We have an open profit of $935. And let's take a quick look at our analysis tab. That $65 insurance was well worth it because we made up more than that just in the profit today as we opened, and it really didn't cost us anything at all, and the insurance was very, very good for us. So here we are today. Like I said, we're up $135. We are moving back towards the center very nicely on our position. We're going to keep a close eye on this position. Of course, we are in expiration week. I normally like to get out earlier. However, we're going to try to squeeze every little bit of profit out of this position, out of our positions as possible. We have the positions on the diamonds, the EEM, the IWM, and the SPY continuing to go. Let's take a look at each individual position just for a second. But before we do that, let me just show you something. We want to take a quick look at the VIX. And let's take a look at where we are. We have we went up here a little bit. If you can take a look down here in the corner, we're going to take. We've been dropping significantly. I thought for sure that I didn't know for sure, but I thought possibly we could jump up here and retest this level up here around 21.50.22. And that didn't happen this morning, so that's why we closed out our insurance. We bought the QQQs as insurance. And we closed those out early this morning when we saw that in fact the market was not going to drop like a rock and retest those VIX levels. So we're back. We're falling back down again. I think we're going to retest these 18 levels, so we should be up for the day. We'll see exactly and keep monitoring our position. But at this time, we don't really have to do anything. As long as we stay to the upside, we've got plenty of room to move to the upside here. We're going to continue to make a profit on this position today. We should be close to $1,000 in open profit. Now remember, we're only trading 1 or 2 contracts here, so this is a pretty good profit. And all we had to do is just kind of be patient, wait. And now this white line here, which is our current profit and loss position, is joining the expiration green line here, which is only 5 days away now. Let's take a look at our monitor tab here, or our trade tab. We can see there's only 4 trading days left in this position. Ideally, we'd like to be in the center, and all of our positions would expire absolutely worthless, and that will give us the maximum profit. So we just have to sit back, relax, going to monitor. Now, normally during a trade, when you're putting on trades 30, 40 days ahead of time, you don't really have to be that concerned with the day-to-day kind of market fluctuations, but as we get closer to expiration, that's where you really want to pay attention to your position. So that's what we're going to do if you want to extract as much profit as possible. However, I do not recommend holding positions into expiration week. Price is the biggest risk during expiration week. Let's just take a quick look at our monitor tab for a second and take a look at our numbers. Our delta is a very nice little positive 94. Our gamma is a negative 190. And all gamma really means is that it's the amount that the delta is going to change based on the position, overall position. Theta has increased to a nice $129 a day. So going into expiration week, we should expect to collect another $128 every single day that we're in expiration. And our Vega is at 121, and it's a positive number, meaning that if the Vega goes up, we will increase our profits by $121. However, given that delta is also a positive number, that they kind of neutralize each other there. So what we want to do, and our current profit open is 925, and we want to just take a look at our Analyze tab here for a second. As long as we can continue to move up, the Dow Jones is right now is up about 30 points. If we continue to move up, we'll be doing very, very nicely here. We're going to keep an eye on the market very closely. We want to be able to stay in this center position. All right, tradeologists, hey, trade with confidence.